Will the financial bailout work? Not likely. The recent volatility on Wall Street and in the world's economies is virtually unprecedented and is likely to remain so for now at least. But don't blame Wall Street for the jumpiness. It could very easily be seen in the context of a decisive, coordinated effort by governments worldwide to manipulate stock markets higher by every means possible without regard to such niceties as fundamentals, the rights of shareholders, or the laws of financial gravity, or the theory of economics at all. Experts say this will all likely fail eventually by running into the usual set of problems that we have discussed. Levels of debt, deleveraging, and slowing growth that no additional amount of monetary or fiscal stimulus can fix or vanquish. Battle lines for this epic contest between the physics of debt and government efforts to prop up the system with toothpicks and rubber cement or band-aids can be seen most clearly in the rhetoric in Congress this week. Virtually every respected authority in the world of real capital or economics believes the bailout bill before lawmakers won't solve our banks' problems, or Wall Street's problems, or the economy's problems. Yet the nation's political leadership has pressed on to pass it with the confidence of the captain of the Titanic. And at best, Congress could possibly pass a quick fix that's bound to fail in the long run. Meanwhile, some experts offer solutions, including a $500 billion in tax rebates that could possibly work a little bit, or at least give some money to the poor, struggling consumers. The bill could very easily pass in the Senate and the House. The Federal Reserve will flood the system with additional money, just as it did in 1999. The markets might possibly lift a little bit, but that won't mean all is well, not even by a long shot, as eventually the plan must actually work and do something. And every credible expert that has spoken believes it won't. Here's the problem. As explained by John P. Hussman of the Hussman Funds, the financial bankruptcies we've seen in the past 6 months have come in order of their gross leverage, or the ratio of total assets to shareholder equity. The more leveraged Bear Stearns, Lehman Brothers, Washington Mutual, the more vulnerable they were. The reason is that as loans of a financial company lose value because of underpayment, company executives must write down the asset side of their balance sheets, and at the same time reduce their shareholder equity on the liability side. Banks are allowed to lend only in proportion to their shareholder equity, so as the equity becomes thinner, banks are less able to lend money to make a profit. The drying up of the credit. Sophisticated customers then see that the banks are in a very precarious condition and start making withdrawals. And so to satisfy those requests for withdrawals, banks are forced to liquidate more assets at distressed lower prices, prompting further reduction in shareholder equity. This process is then repeated in a very vicious cycle until shareholder equity goes to zero and the company becomes insolvent or declares bankruptcy. not good news for the banks. So, what the U.S. government now proposes to do is to buy the questionable assets to protect the institutions against failure. Yet just taking the assets out of the mix would be doing nothing to provide additional bank capital, so the balance sheets would be just as fragile and prone to bankruptcy. It really won't fix anything. At best, you'd be allowing banks to liquidate their bad loans more easily to meet the demands of customer withdrawals. And the only way buying the bad assets or debts or bad loans that could increase capital would be if the Treasury overpaid for them. And that would be so politically unsavory that it isn't worth even mentioning or contemplating. At some point, corporate bond prices will fall enough and reach a high enough yield that investors who specialize in distressed investing will supposedly begin to buy. Of course, that's the way things are supposed to work. Yet, it's not quite glamorous or nearly fast enough. The Treasury should offer $500 billion in rebates to U.S. citizens, but of course, a lot of people didn't even get the rebates from the last time, for whatever reason, one reason or another. But instead of paying with a check, it should deliver new zero-coupon Fannie Mae bonds. A zero-coupon bond is one that accrues interest for some specified period, and then is paid all at once later on. If people wanted to spend the money right away, they could sell the bonds for whatever they could get for them in the marketplace, which wouldn't be very much. And if they wanted more money, they could hang on to the bonds, and the government would pay the full face value at maturity. Nice and simple, supposedly. The genius of this plan is that it would deliver the money straight to the people instead of to Wall Street. We'd still be borrowing from our children, but we'd be borrowing less. Fannie Mae, whose debts are now explicitly guaranteed by the government, could use the money it raised to buy banks' bad assets or debts, or provide capital directly. By this plan, citizens would become banks' creditors, not their owners, so you wouldn't have that bad smell of socialism or nationalization. Waiting, hoping, failing. Experts say the Senate plan won't work. It proposes to buy bad debts or assets only from institutions that decide to participate. Any institution that can avoid the bill's constraints, such as limits on executive pay, will try to do so. Indeed, most likely only the weakest banks will opt into the program in an act of desperation. The others will languish and deteriorate until they too become so weak as to leave them without any choice. So, to wit, in summary, we are on the cusp, on the edge of a historic moment in world financial history. Virtually every country in the world is trying to throw truckloads of borrowed money at a problem created by borrowed money, and created by greed, pure greed. Yes, this is about greed, isn't it? And no, the bailout financial plan is not going to work. Not in the long term. You have to help the poor consumers, or the poor people. You have to help the small businesses. You have to give people more money. Well, anyway, that won't work in the long term either, because this is all about something else, something more, something bigger. And these are more signs of the end times, transition days, and there are many signs.